It should come as no surprise that the fear has risen in the markets, with 3 straight months down nearly 11% from the peaks in July. It's got many worried that we are beginning to enter a new bear market. Last year, 2022, was a bear market, and in 2023, we got a technical bull market. So are the markets about to flip yet again into a bear market? In this video, let's look at the technicals. Let's look at the chart patterns for the major stocks in the US to identify when this bottom could end, and of course, go along with the ride to the upside yet again. Make sure you hit that like and subscribe button. Thanks again for all of the new subscribers that have come across. I've got a lot to get through in today's video, and a big shout out to the 7% of women who follow the financial and crypto channels as well. You guys know that this is your home of macro cycle analysis, studying the past to forecast the future, yada yada, crypto, Bitcoin, real estate. You get the idea. But if you are new here, we don't follow the fear porn that continues to tell you that the market is going to collapse. But I think it's important that we follow up on some of the charts that we have been covering here on the channel, in particular the macro cycles, just to give everyone a good starting point before we dive headfirst into the meaty parts, looking at the technicals on these particular charts. So the overarching theory that we use here is the real estate cycle, the 18.6 year, which goes from 17 to 23 years, but the average is roughly 18.6. We're currently in this stage of the cycle here, and markets are heading up. But this, of course, is not a straight line. And sometimes the bears get squeezed, sometimes the bulls get squeezed, and vice versa on the way up. I've got more detail to cover in the real estate cycle itself, but we just all need to understand where we currently sit so that we can move on with the technicals so that we're all on an even playing field here. This is what the chart has shown. This is what the cycle has shown, that we are getting ready to head into this last stage of the peak, which is essentially a symptom of what is to come, which will be a mega collapse. So we're preparing to make the easy money on the way up, because these times are going to be very difficult. After 2026, their times are going to be quite tough. It could start around 2027, 2028. We've got plenty of years to have a look at that, but I just want to get us on the same playing field right now, and this is where we currently sit. These times might look like a straight line up, but they are the most difficult, with higher highs, lower lows, and everything in between, until we get to the end where everything looks very, very easy, and you'll have everyone telling you that we're in a bull market, and that's usually the end. The next piece we'll have a look at is the market sentiment. Fear today, 31. This is on the stock markets, before we get into Bitcoin, of course. It's in extreme fear was yesterday. We had fear last week. We had extreme fear a month ago, and a year ago, we were in greed. So we're currently in October. The markets were just coming out of their cycle low for the SP500. If we look at this on a timeline here, October was back in these areas. You can see that it started to climb up into the greed. But what we've seen over the last couple of weeks is the reading lessen on the fear. So the fear has become less, even though the price has gone a little lower. So there is a divergence happening here when it comes to the market sentiment, how people feel about the market, and the prices themselves. When we saw this with Bitcoin in the winter, I guess for the Northern Hemisphere of 2022, or our summer here in Australia, we saw these lows, which was the cycle low, and we talked about it here on the channel. You guys can let everyone else know in the comments section. This is what we were talking about when it came to the lows, this whole period being a transitional period going into a bull market. That we saw the extreme fear happen in June. That was on the collapse of all of the DeFi and the CeFi and everything else in crypto. And then we had a FTX collapse, which brought the price lower, but at that exact time, the market sentiment was rising, which means the fear of the market was becoming less, and eventually it would flip to greed. But these macro cycles take a fair bit more time than the days or the weeks that most people have to pay attention to a market, or they want their money, they want their return much quicker than the market is going to give it to them. So if you have patience, you're going to make it a long way in this market. So that's where we currently sit with the fear and greed. We can see that also rising. Now, there's always new narratives coming into the market. There's something every single week. I post about those up here in a pinned comment so that you can follow this and keep it as part of your trading and investing so that you don't get screwed with the wall of worry. Markets heading up, there's always some sort of fear that comes out every single week. Now, I've gone through and I've posted a lot of stuff here over the months. I'll leave that for you to go and have a look at. But the latest thing I've seen on Twitter now are financial conditions. This does sound scary. Financial conditions, basically, there is a lot of tightening going on with the banks, being that the banks don't want to be lending out too much. So everyone's fearful that the markets are going to collapse, which is fair enough. It seems like that for sure. But let's have a look at some of the data when we see the financials total return from the CNI. What's the CNI? Commercial and industrial loans growth has gone negative. So it's tightening. So we can see from this chart, and this stuff gets posted on Twitter, of course, etc. You know the deal. Everyone gets scared, and then these things start to circulate and reshare, retweet. So what happens? Well, we've got only a few data points, but what I find very interesting about the data points, which is why I brought up the real estate cycle at the beginning here, is that a lot of these tightenings come near the bottoms of the cycle. Look at that. You've got the bottom here in 1975. You've got another one around 1990. You've got another one in 2009. And the markets went up from that point for many, many years. Now, I'm not saying that this is going to be the same thing. As I just pointed out, I think this is coming towards the end of a cycle, somewhere around these particular years, somewhere around those years, I want to reiterate. But we've also seen one on the mid-cycle slowdown, which was through 2001, which then lasted another 12, 18 months from that point. We also saw one in 2021 on the way up. And if you look at it in terms of price, we're above that price at this point in time. So when we look at the data going forward a year, 2 years, 3 years, you can see even going back going forward from this point, 6 or 9 months, you can see it's had a pretty positive return on the markets when this signal happens. Why the hell does that happen? If the banks are shrinking their loans, commercial and industrial loan growth has gone negative, they basically don't want to lend out too much. Why is that an issue? Well, those signs typically, or at least what we can see from the data here, they tend to happen towards those low points because everyone's scared at the lows. Doesn't mean that tomorrow the markets are going to bounce 50, 100%. Doesn't mean it's going to be next week or next month, but these things can take time because we're looking at larger cycles here. And that's what at least this data has shown each of those occasions, which comes in around those very significant times, which I'll have to bring up a chart in the future. But essentially the low of this 18, 20-year cycle has been around those points each time, around the mid-70s, the early 90s, and of course around the 2009 to 2012 was the beginning of the cycle that we're currently in. So I don't see this as such an issue. Maybe this thing takes off as a big issue for the media and starts to scare us, which will then become another wall of worry news item that basically was a nothing burger, and eventually the markets continue to head up. Onto the technicals, and when is the stock market going to bottom, and how is that going to affect Bitcoin as we've broken out of $32,000? Well, I want to show you the top 7 stocks in the US. They take up about 30% of the SP 500. So if these 7 stocks move, it's going to greatly affect the SP 500 and even more so the Nasdaq, because essentially they make up a big part of the Nasdaq as well. So at the moment, the top 7 stocks: Apple, Microsoft, Google, Amazon, Nvidia, Meta, which has climbed above Tesla because it's just had a little bit of a drop here, Berkshire Hathaway, Tesla, etc. Okay, so we got these big stocks that make up a third of the S&P 500. More data here just to show that, account for nearly 30% of the index. Now onto the S&P 500, we have 19 hours to go until the month of October closes, but I think it's safe to say that we'll see a red October unless this next trading day can bounce up and close above roughly 4,300 points all the way from 4,166. This week, being November beginning tomorrow, I'll do some November monthly analysis on Bitcoin and the stock market, so stay tuned to those. Give us an idea of what I think is coming up for the end of 2023 and potentially into the first half of 2024. So you know the deal, like and subscribe. And if you are one of the 27% that have not subscribed, let me know in the comment section, or easier still, just hit the subscribe button. You can always unsubscribe anytime. Shout out to the top 5 countries here: US, Oz, UK, Canada, and Netherlands. A few more bits of data. I can't get enough of it. And it looks like a third of you are in my age bracket. All right, back to the S&P 500. 3 red months I'm going to go through this in a future video because I think we'll run out of time in this, but just looking at what are the likelihoods of the S&P 500 bottoming and then moving up from that point after 3 straight red months. But the main thing we want to look at here is the 50% level, the full range 50% of this bull market from the October 2022 low to the July top. We have a price point here of around 4,050 points. That's for the S&P. For the Nasdaq, the 50% level is at 13,000 for a round number, call it 200. So 13,200, and you can see this zone here where there's some previous tops being resistance, some previous bottoms being support, and that's around that exact price point where the market was held up in April for the US debt ceiling crisis, and then it took off from that point. So really, it wasn't a crisis. The market took off from there, and it had 1, 2, 3, 4, 5 straight green months. Higher highs, higher lows. February was the only month that basically held the market before it was able to push through in March after the banking crisis as well. And now it looks like we're still having a healthy correction. Now, I know there's a lot of people that are expecting this to be a bear market. Maybe it goes deeper, and that's what I want to look at now with where could this end and why would it end at those points. So the market's got a few areas of support, roughly around that 14,000 or 13,800. You can see these previous tops, previous lows. We can just draw an easy line across the screen there. Pretty basic. 50% level is a key level, so keep an eye on 13,200 as well. Could the Nasdaq get to that point? And for the S&P, could it get to 4,050, which was also the low in May, before it starts to find its ground and bounce away again? Seasonality, maybe we start to see something for late November and December as well, being that Halloween effect, which we'll get onto in future videos, along with an update on sell in May and go away, which I can give you a quick teaser, was actually a fail for a lot of stocks and also Bitcoin. So sell in May, go away, essentially sell on May 1st, come back on the 31st of October was a fail. Okay, so don't always believe those old sayings. But in the case of what we're looking at now, where could this bottom form? Well, we've looked at the 50% level and there is still some room to the downside, especially for the Nasdaq after a huge pump to the upside, and there is some clear support there as well. Markets have to digest these moves, especially when they are not in new all-time high territory, because essentially we have a bit of a balance between the bulls and the bears. The bulls have been winning for the last 5 or 10 months when you account from the October 2022 low, but you had a very strong move to the upside, especially for the tech stocks. So naturally, they need to take some profits, and the bears need to come back into the game as well. So there's still potential for some more downside. So how does this look? Where is this going to be? Well, I'm going to be paying particular attention to the top 7 US stocks, which we just looked at here on the largest American companies by market capitalization, and have a look at a few of the other stocks which are just outside of the top 7. Tesla, still very, very big, so we're going to obviously have a look at that. Berkshire Hathaway, Eli Lilly, United Health, Visa, Walmart, Exxon, JP Morgan, and Johnson & Johnson, amongst others in the future. But just have a look at the charts here. Very, very simple. Nothing too detailed here because it doesn't need to be. This is very, very simple. Apple has gone up. Green after green after green, higher highs, higher lows, which is what my Gann swing indicator is showing me here with that yellow line. Not just green months, but actual higher highs, higher lows. It had 6 months straight up from that January low, putting in a new all-time high in July. That's a new all-time high when a lot of other markets never hit their new all-time high. Naturally, you'd have to expect a pullback. So we've had 3 red months now, still trading around the previous all-time highs that were set back in late 2021. Now, another interesting thing here is when I throw it onto the log chart, this was the GFC collapse, 2007 into the bottoms here in 2009. And I've just got a diagonal across the top here, touching a few of those tops. You need multiple points here, and then again along the bottoms, and then just a rough line here through the middle, which isn't the exact middle, but you get the idea. I'm not using this to go and trade off of. I just want to look at it as like a Bollinger Band or some strength and weakness, just to let us know, have we overshot the mark and are we coming back to test the midline or even maybe the bottom of the range, but it's still in a strong move to the upside. When you account for this 2007, 2009, this is roughly a 14 to 16 year move in a logarithmic channel. And sometimes even through 2020, 2021, it's gone above that level. This has been a monster move to the upside. naturally it needs some time to chill out. If it starts to break down from the underside, all bets are over. The stock market's going to be well and truly down. Things are going to be terrible. But the market is still above the 50% from the low here in January, macro low here, and it still has a little bit of room to come back and retest this 50% at around $160. That would look like a very significant buying opportunity. Obviously put in some stops below those levels in case it keeps going, but that is going to be some good time for the tech stocks, at least, in this case Apple, to find and test support before potentially continuing up. This is over a macro time frame. I don't think it's going to be tomorrow, next week, etc. I hope you get that idea, but there is still some room to the downside, even though we are trading in the strong half of the 50% tool here. You can see we're above the level, and this is going to be the weak side under here. Now you got that idea how that's all working. Let's move on to Amazon. Not as strong, but it's underneath the 50% of the bear, but still above the 50% of the move to the upside. So it also put in a fresh high here just last month before September went red, and now October is nice and green, coming back to test 135. So it's not as weak as some of the other stocks in the rest of the 500, and it's come back and almost tested that 50% level. If we have a look at it from the higher low, which I believe was March, then yeah, almost to the dollar. It was a few bucks off that 50% level. So I'm going to keep that here. There was still room to the downside, but it looks like it's wanting to close a bit higher to come back and test some of these higher prices. Google, same sort of deal. It's above its major 50%. So that was the bear market here, and it's had a couple of months off. Let's have a look at Facebook. Same sort of deal here. It's trading at these high prices after a huge run to the upside, still above 50%, and has room to move to the downside, but still remain in a strong position. So we've seen Apple, Amazon, Google, Facebook, 4 out of the top 7. They're all in very strong positions, but they still have room to the downside to come back and test and correct and digest their extremely strong moves to the upside. Now we still have a few more to check out, and Tesla and Nvidia are actually weaker, but you can start to see now when the stock markets will bottom and potentially turn around from that point. So we have to see how these top 7, top 10 test those 50% levels, and then see if from that test they do rise from that point. When that happens, most likely, no guarantees, but most likely the stock markets will bottom at that particular point. Carrying on, we've got Microsoft, also nice and high here, testing those all-time highs again. 50% at 290, so it still has room to the downside, but it's in a strong position. There's strength, needs time to digest, and then potentially move to the upside. Now, the two that are letting the team down here, Nvidia, still in the strong half here, very strong. There is a gap to the downside, and 50% sits at around 305. It obviously had a mega move, huge move from the October 2022 low, which was the cycle low for the Bitcoin, for the bear market of the S&P, 365%. Naturally, it needs to digest that move. These guys who made a killing will need to take some profits. So keep a lookout for this. This could be what holds up the S&P or the Nasdaq and the Nasdaq from moving higher quicker. So that's why this move that they're digesting now for the indices might take that a little bit longer. Tesla, which just dropped out of the top 7 to Berkshire Hathaway, is the weakest of the lot, breaking underneath the 50% levels, now under $200. And this is probably one of the last lines of support here, which is the April low at around $150. So keep an eye on that as well. In the meantime, you've got Berkshire Hathaway, which last month hit a new all-time high as well. And in terms of its 50%, you can see it still has a little bit of room to the downside as well. So again, now we're in the top 8. All these markets have had very, very strong moves. They need some time to digest. And eventually we'll see how this test performs. Do we see more upside from that point? But at least from what the analysis is saying, that will be a bottom in the market. I think it'll be a significant low. And from that point, we'll have to see whether we hang around at those prices for longer or we start to head up from that point. Now, there are a lot more stocks to get through, but I know the video is getting on now. Just want to quickly show you the 50%. And you can start to see the strength of these stocks, which have just gone haywire. Eli and Lilly and Company, I think it was number 11 or so on the chart here. Number 9. You can see the strength here. It also has some room to move to the downside, especially after such a significant spinning top at the top, which typically is a topping signal. So just keep a lookout for that. And I'll throw one more up here, which is ExxonMobil. Also trading at all-time highs. Of course, this is probably off the back of the oil price being high as well. Keep an eye on the 50% level, which comes in almost neatly at $100. A lot to have a look at here, a lot to keep a track of, but if the stock markets have a chance of bottoming, these stocks, these top 7, 10, 15 stocks, they're going to be the ones that are going to lead the way into that next move up. Or if that test fails, they will drop the market. This is going to be critical. Keep an eye on these stocks and where they currently sit against their 50% levels for clues of when this stock market is going to bottom. Speaking of market bottoms, we've been following a roadmap here of the SP 500, which typically shows that we should start to get a run out of the lows around November, December. That doesn't mean we have to run into new fresh highs from where we currently are, but it could mean that we find a low in the coming weeks and then start to work our way higher and test some of these key levels, which will be resistance. As for Bitcoin, it is now digesting the move after breaking out of $32,000. Everything is still looking on track, and if it is able to hold here for the close of October, that would then put it at roughly, at this current price, an 18% increase from the 1st of May, which was the old saying, sell in May and go away. In this case, they would be down 18%. But if you're bought on the 1st of May, you'd be up 18%. Now, I've got some more forward return data that I want to get through with you guys this week. So make sure you are subscribed, like the content. Check out the links in the top of the video description for our free crypto and economic report. And if you want to have a look at the free Discord as well, check out the trading results from our traders over there who are crushing it. You can also do that from that particular email. There'll be a link there to get into our free Discord. All right, guys, thanks again. That was a huge video. Tomorrow, I hope, will be a little shorter. So until the next one, take care and peace out.